price on the screen is not real. Every number, every ticker, every quote flashing across financial terminals worldwide, manipulated, not by hidden conspiracies, but by official government policy, documented, legal, systematic. The business leaders who understand this are repositioning their capital right now. Those who don't are building empires on quicksand. The evidence is irrefutable. The mechanism is exposed, and the consequences are already unfolding. Welcome to Global Finance Revealed. If you've spent decades building businesses, managing investments, or simply trying to understand why the economic rules seem to have changed, this channel speaks your language. We ask a small favor. Subscribe to this channel, not with a hurried click, but with the understanding that what we discuss here could protect years of your hard work. We're not chasing trends. We're documenting structural shifts. And please, share with us in the comments. From which corner of the world are you watching this? What markets are you observing? Your perspective matters. Now, let us examine what has happened to the free market. For 70 years, business leaders operated under a fundamental assumption. Prices reflected reality. When wheat prices rose, it signaled scarcity. When stock prices fell, it indicated reduced confidence. When interest rates climbed, it meant capital was expensive. Supply met demand. Buyers met sellers. The invisible hand, guided allocation. This was not merely theory. It was the operational framework upon which every serious entrepreneur built strategy. Financial projections, investment timelines, risk assessments. All of it rested on one premise: the price is real. That premise is now obsolete. In March 2023, something extraordinary occurred in the United States Treasury market. The most liquid, most watched, most critical financial market on earth experienced a price movement that defied every known principle of supply and demand. Treasury yields should have risen dramatically. The federal government was borrowing trillions. Inflation was accelerating. Foreign central banks were reducing their holdings. Every classical economic indicator pointed toward higher yields, higher interest rates, a higher cost of government debt. Instead, yields fell. Not slightly, not temporarily, but systematically, persistently, impossibly. Analysts scrambled for explanations, perhaps flight to safety, perhaps deflationary expectations, perhaps technical factors. None of these explanations survived scrutiny. What actually happened was far simpler and far more consequential. The United States government intervened directly in the pricing mechanism, not through traditional monetary policy, not through interest rate adjustments announced by the Federal Reserve, but through direct, systematic, continuous purchasing operations designed specifically to push prices upward and yields downward. This was not speculation. The operations were documented in Federal Reserve balance sheet data. The Treasury Department's own reports confirmed the scale. The mechanisms were hiding in plain sight, in official government publications that few business leaders had time to read. But the implications were staggering. If the government could manipulate the price of its own debt, what else could it manipulate? The answer arrived quickly. Energy markets, equity indices, corporate bond spreads, even commodity futures. One by one, markets that had functioned on supply and demand principles for generations began exhibiting price behavior that contradicted fundamental analysis. Oil prices remained elevated despite rising production. Stock indices climbed despite deteriorating earnings. Corporate debt traded at prices that ignored default risk. The pattern was unmistakable. Prices were being managed, not by market forces, but by policy decisions. For the business community, this represented a crisis far deeper than a recession or a market correction. Those events, however painful, still operated within understood rules. Entrepreneurs knew how to navigate downturns, reduce costs, preserve capital, wait for recovery. But this was different. This was the replacement of the pricing system itself. Consider the position of a manufacturing executive planning a 5-year capital investment. Traditionally, he would analyze commodity prices, labor costs, interest rates, and construct financial models based on these inputs. But if those prices are administratively determined rather than market determined, every assumption becomes unreliable. If steel prices are held artificially low through government intervention, his cost projections are fiction. If interest rates are suppressed below their natural level, his financing assumptions are fantasy. If equity valuations are inflated through systematic purchasing programs, his acquisition strategies are built on illusion. The executive is no longer operating in a market economy. He is operating in a managed economy, where the managers have not published the management rules. This is not a temporary emergency measure. The interventions have become permanent features of the financial architecture. The tools have been institutionalized. The legal frameworks have been established. The precedents have been set. And most critically, the interventions are directional. They push prices upward not to reflect genuine scarcity or increased value, but to serve policy objectives that have nothing to do with economic efficiency. The free market, as a functional pricing mechanism, has been suspended. What replaced it is something entirely different. And understanding this replacement is now the most critical strategic imperative facing every serious business leader. The question is no longer whether prices are manipulated, but how to operate when they are. The machinery operates in silence. No press conferences announce its activation. No headlines declare its purpose. No government official stands before cameras explaining what is happening. Yet every trading day, in the pre-dawn hours before markets open, the mechanism engages and prices move upward. Not randomly, not organically, but systematically, predictably, artificially. To understand how this works, one must first abandon conventional thinking about government intervention. This is not about bailouts during crises. This is not about emergency measures during panics. This is infrastructure, permanent, automated, embedded into the financial system itself. The primary tool is deceptively simple: liquidity injection with directional bias. Here's how it functions in practice. Each morning, the Federal Reserve conducts what it calls repo operations. Officially, these are temporary lending facilities designed to ensure smooth functioning of overnight funding markets. The official explanation is incomplete. What actually occurs is far more sophisticated. The Fed offers to purchase securities from primary dealers, banks, and financial institutions with direct access to Federal Reserve operations. These purchases inject cash into the financial system. But here is the critical detail that most analysts overlook. The timing, volume, and selection of securities are not random. They are calibrated. When equity markets show signs of declining, repo operations increase in volume. When Treasury yields begin rising toward levels that would increase government borrowing costs, repo operations expand in duration. When corporate bond spreads widen beyond acceptable thresholds, repo operations broaden in scope. The pattern is unmistakable to anyone examining the data systematically. The operations do not respond to liquidity shortages. They respond to price movements. Specifically, they respond to downward price movements. A portfolio manager at a mid-sized investment firm discovered this pattern in late 2024. He was not looking for conspiracy. He was simply trying to understand why his quantitative models kept failing. His algorithms predicted Treasury price declines based on supply-demand fundamentals, massive government borrowing, reduced foreign purchases, inflation concerns. Every factor pointed downward, yet prices moved upward. He began tracking the timing of Federal Reserve operations against price movements. The correlation was extraordinary. Within hours of Treasury prices beginning to fall, repo operations would surge. The fresh liquidity would flow into the exact securities showing weakness. Prices would stabilize, then rise. This was not coincidence. This was intervention. But the mechanism extends far beyond repo operations. The Working Group on Financial Markets, officially established after the 1987 stock market crash, has evolved into something its creators never publicly acknowledged. This group, comprising the Treasury Secretary, Federal Reserve Chairman, SEC Chairman, and a CFTC Chairman, possesses legal authority to intervene in any financial market during periods of emergency. The definition of emergency has expanded considerably. In practice, the working group now treats any significant market decline as justification for intervention, not through announced policy changes, but through coordinated operations across multiple markets simultaneously. Here is how it works in real time. Suppose equity markets begin declining sharply. Within minutes, several things happen in sequence. First, the Federal Reserve signals increased liquidity availability to primary dealers. Second, the Treasury Department adjusts the timing of its debt auctions to reduce immediate supply pressure. Third, regulatory agencies communicate with major financial institutions about orderly market conditions. Fourth, and most significantly, entities with government connections begin purchasing equity index futures. These purchases are not small. They are large enough to halt downward momentum, large enough to trigger algorithmic trading systems that interpret the buying as a trend reversal, large enough to change market psychology. The purchases appear to come from private institutions, but the funding traces back to facilities provided by government-connected entities. A former Treasury official, speaking privately to a financial journalist in 2025, described the system bluntly. "We have built a one-way valve. Markets can rise freely, but significant declines trigger automatic stabilization responses." Stabilization is a careful word choice. What it actually means is price elevation. The mechanism also operates in commodity markets, though with different tools. The Strategic Petroleum Reserve, originally created for genuine energy emergencies, has become a price management instrument. When oil prices fall below levels that threaten domestic energy producers, the government announces purchase programs. When prices rise above levels that create political problems, the government announces release programs. The stated purpose is emergency preparedness. The actual function is price band management. Agricultural commodities face similar intervention through subsidy programs that are no longer tied to farmer welfare but to price stability targets. Metals markets experience intervention through government purchasing programs disguised as strategic stockpiling. Each market, each commodity, each asset class now operates within invisible boundaries. Prices can rise indefinitely, but they cannot fall beyond certain thresholds without triggering intervention. For business leaders, this creates a profound strategic problem. Traditional financial analysis assumes that overvalued assets eventually correct to fair value. That assumption no longer holds. Assets can remain overvalued indefinitely because the government prevents the correction. A real estate developer in Texas experienced this firsthand in 2024. He had positioned his company for a commercial property correction. Valuations were clearly inflated. Occupancy rates were declining. Fundamentals pointed toward price decreases. He waited for the correction and waited and waited. It never came. Instead, government-backed mortgage programs expanded. Federal agencies increased their commercial real estate holdings. Regulatory changes made it easier for banks to avoid recognizing losses on property loans. Prices remained elevated. The developer's strategy, based on sound fundamental analysis, cost him millions in missed opportunities. His competitors, who ignored fundamentals and simply assumed government support would continue, prospered. This is the new reality. Fundamental analysis has become subordinate to policy analysis. The question is no longer, what is this asset worth? But rather, what price does the government need this asset to maintain? And the answer is almost always higher than fundamental value would suggest. Because the entire system, the government's fiscal position, the banking sector's solvency, the pension system's viability, the political establishment's credibility, depends on asset prices remaining elevated. A collapse in asset prices would expose the insolvency underlying the entire structure. Therefore, prices cannot be allowed to collapse. The mechanism ensures they do not. This is not temporary. This is not reversible through normal political processes. This is the new architecture of American finance, and every business decision must now account for it. The distortion spreads like a crack in glass, slowly at first, barely visible, then suddenly everywhere. When prices lie, economies fracture. Not immediately, not dramatically, but systematically, inevitably, catastrophically. The first casualty is something most business leaders never consciously consider, the information function of prices. In a genuine market, prices communicate truth. A rising price signals scarcity. A falling price signals abundance. These signals guide millions of independent decisions every day. A farmer decides which crop to plant based on futures prices. A manufacturer decides which materials to stockpile based on commodity prices. An entrepreneur decides which industry to enter based on profit margins reflected in equity valuations. Each decision relies on price signals being honest. When those signals are manipulated, every decision becomes contaminated. Consider what happened in the American housing construction industry between 2021 and 2025. Lumber prices were artificially suppressed through a combination of strategic reserve releases, import subsidies, and regulatory pressure on futures markets. The official justification was affordability and inflation control. The actual effect was catastrophic misallocation. Construction companies, seeing low lumber prices, expanded operations aggressively. They hired workers, purchased equipment, signed long-term contracts, built inventory, all based on a price signal that was false. When the government support mechanisms eventually shifted, as they always do when political priorities change, lumber prices didn't gradually adjust. They exploded. Within 6 months, prices doubled, then tripled. Construction companies that had expanded based on artificially low input costs found themselves trapped. Projects became unprofitable overnight. Contracts signed at old prices became financial disasters at new prices. Dozens of mid-sized construction firms, companies that had survived recessions, market cycles, and competitive pressures for decades, collapsed within 18 months. Not because they made poor business decisions, but because they made decisions based on government-manipulated price signals that bore no relationship to underlying supply and demand. This pattern repeats across every sector where price manipulation occurs. And price manipulation now occurs everywhere. The second consequence is more insidious: the destruction of capital allocation efficiency. In a functioning market economy, capital flows toward productive uses and away from unproductive ones. Profitable enterprises attract investment. Unprofitable enterprises lose funding. This process, brutal as it sometimes feels, is how economies grow wealthier over time. Resources shift from less valuable uses to more valuable uses. Price manipulation reverses this process. When government intervention keeps asset prices artificially elevated, capital flows not toward productivity, but toward political connectivity. A technology entrepreneur in Silicon Valley discovered this in 2024. His company had developed genuinely innovative software that reduced logistics costs for manufacturing firms. Real product, real customers, real revenue growth. He sought venture capital funding to scale operations. Simultaneously, a competitor emerged. This competitor had minimal technology, questionable revenue claims, but significant political connections. The competitor's CEO had previously worked in the Commerce Department. The company's board included former regulatory officials. Both companies sought funding in the same month. The innovative company struggled to raise capital at reasonable valuations. The politically connected company raised 3 times as much at 5 times the valuation. Why? Because investors had learned a critical lesson. In a manipulated market, political access matters more than product quality. The politically connected company could navigate regulatory advantages, could access government contracts, could benefit from subsidies and support programs, could rely on bailouts if things went wrong. The innovative company had only its product. In a genuine free market, the product would be enough. In a manipulated market, it is not. Capital flowed toward political connection and away from innovation. Multiply this pattern across thousands of investment decisions, and the aggregate effect becomes clear. The economy grows less productive, less innovative, less dynamic. Not because entrepreneurs lack creativity, but because the incentive structure now rewards political maneuvering over economic value creation. The third consequence strikes at the foundation of business planning itself. The destruction of calculability. Every business operates on projections, revenue forecasts, cost estimates, investment returns. These projections require some degree of predictability in the economic environment. Not certainty, but calculability, the ability to assess probabilities, to model scenarios, to make informed judgments about future conditions. Price manipulation destroys calculability. A manufacturing executive in the Midwest experienced this directly in 2025. His company produced industrial components. Planning required projecting costs for steel, energy, labor, and transportation over a 3-year horizon. Traditionally, he could model these costs with reasonable accuracy. Steel prices correlated with iron ore supply and construction demand. Energy prices correlated with production levels and seasonal factors. Labor costs correlated with unemployment rates and skill availability. By 2025, none of these correlations held. Steel prices bore no relationship to supply and demand fundamentals. They moved based on government stockpiling decisions and trade policy announcements. Energy prices disconnected entirely from production economics. They fluctuated based on strategic petroleum reserve releases and regulatory interventions. Labor costs became unpredictable, as government subsidy programs created artificial wage floors that appeared and disappeared based on political cycles. The executive could no longer construct meaningful financial projections. Every model, every forecast, every budget was essentially fiction. He was operating blind. His response was rational. He stopped making long-term investments, stopped expanding capacity, stopped hiring for growth. He shifted to a defensive posture, preserving capital, maintaining flexibility, waiting for clarity that would never come. Across the economy, thousands of executives made identical decisions. Investment declined, not because opportunities disappeared, but because the ability to evaluate opportunities had been destroyed. This is how manipulated prices kill growth, not through dramatic crashes, but through the slow strangulation of business confidence. The fourth consequence is perhaps most dangerous: the creation of systemic fragility. When prices are prevented from adjusting to reality, imbalances accumulate. Unsustainable business models persist. Inefficient firms survive. Malinvestments compound. All of this creates hidden fragility. The system appears stable. Prices remain elevated. Markets seem calm. But beneath the surface, stress builds. A pension fund manager in Colorado recognized this in late 2024. His fund held a diversified portfolio of stocks, bonds, and real estate. On paper, everything looked healthy. Asset values were rising. Returns met targets. But he understood something critical. Those asset values were artificial. They were maintained by continuous government intervention. The moment that intervention paused, even briefly, the entire structure would collapse. He faced an impossible choice. If he sold assets to reduce risk, he would underperform in the short term. His board would question his judgment. He might lose his position. If he maintained positions, he was exposed to catastrophic losses when the intervention eventually failed. He chose to remain invested, not because he believed the valuations were real, but because the system punished anyone who acknowledged they were false. This is the trap. Everyone knows the prices are manipulated. Everyone understands the fragility, but no one can act on that knowledge without suffering immediate consequences. So the charade continues until it cannot. And when it ends, The correction will not be gradual, it will not be managed, it will be violent. Because decades of imbalances will unwind simultaneously. The business leaders who understand this are not panicking. They are preparing, quietly, systematically, strategically. They are repositioning for a world where prices, eventually, must tell the truth again. The question is not whether that day comes, but whether you will be ready when it does. The rules have changed. Pretending otherwise is financial suicide. The business leaders who will survive the next decade are not those who complain about manipulation. They are not those who wait for markets to return to normal. They are those who adapt strategically to the reality that now exists. This requires a fundamental shift in thinking. Traditional business strategy assumed that markets eventually correct, that overvaluations resolve, that fundamentals reassert themselves, that patient disciplined analysis wins over time. Those assumptions are now liabilities. In a permanently manipulated market environment, different principles apply. Different strategies succeed. Different risks dominate. The first strategic imperative: distinguish between policy-driven and fundamentally driven price movements. This sounds simple. It is not. Every price movement now contains two components: genuine supply-demand dynamics and government intervention effects. Separating these requires systematic analysis that most businesses are not equipped to perform. A commodity trading firm in Chicago developed a framework for this in 2024. They created what they called a manipulation probability index for each market they traded. The index tracked several variables: the timing of price movements relative to government policy announcements, the correlation between price changes and Federal Reserve operations, the presence of unusual trading volumes during off hours, and the divergence between futures prices and physical market conditions. When the manipulation probability index exceeded certain thresholds, they adjusted their trading strategies accordingly. In manipulated markets, they reduced position sizes, shortened time horizons, and focused on momentum rather than value. They stopped trying to predict where prices should go based on fundamentals. Instead, they tracked where government policy needed prices to go. In less manipulated markets, they returned to traditional fundamental analysis. This dual framework approach allowed them to navigate conditions that destroyed competitors who relied solely on conventional analysis. The lesson applies beyond trading firms. Every business must now develop capability to assess policy influence on the prices that matter to their operations: input costs, financing rates, customer demand, competitor valuations. Those who can distinguish policy-driven movements from fundamental movements gain decisive advantage. The second strategic imperative: maintain liquidity beyond traditional prudence levels. In normal market environments, holding excess cash is inefficient. That capital could be deployed in productive investments. Excess liquidity represents opportunity cost. In manipulated markets, liquidity is survival insurance. Because manipulated prices are inherently unstable, the intervention can continue for years, but it cannot continue forever. When it fails, the adjustment is rapid and brutal. A private equity firm in New York learned this lesson painfully in 2023. They had deployed capital aggressively into real estate assets, believing that government support for property prices would continue indefinitely. The support did continue, until suddenly it didn't. A shift in political priorities redirected government resources toward other objectives. The mechanisms supporting commercial real estate prices were quietly withdrawn. Within 90 days, property valuations fell 30%. The private equity firm, fully invested with minimal cash reserves, faced a crisis. They couldn't meet margin calls, couldn't take advantage of distressed opportunities, couldn't weather the volatility. They were forced to liquidate positions at the worst possible moment, crystallizing massive losses. A competing firm, which had maintained what seemed like excessive cash reserves, survived easily. More than survived. They acquired assets at distressed prices and positioned for the eventual recovery. The difference was not intelligence or analysis. It was liquidity. In manipulated markets, liquidity provides three critical advantages. First, it allows survival during sudden intervention failures. Second, it enables opportunistic deployment when manipulated prices briefly touch reality. Third, it provides independence from the financial system's most vulnerable institutions. Business leaders must recalibrate their liquidity targets. What seemed prudent in 2015 is inadequate in 2025. The third strategic imperative: identify sectors where genuine price discovery still functions. Not every market is equally manipulated. Government intervention concentrates in systemically important sectors: government debt, major equity indices, energy, real estate, large financial institutions. But smaller markets, niche industries, specialized sectors often retain more genuine price discovery. A manufacturing entrepreneur in the industrial equipment sector recognized this in 2024. While broad equity markets were clearly manipulated, the specific market for precision machining components remained relatively free from intervention. Why? because it was too small to matter systemically. Government policy focused on trillion-dollar markets. A billion-dollar niche industry operated beneath the intervention threshold. In this space, traditional business principles still worked. Quality products attracted customers. Efficient operations generated profits. Innovation created competitive advantage. The entrepreneur concentrated his expansion efforts in this sector, while avoiding industries where government manipulation dominated. His company grew steadily while competitors in manipulated sectors struggled with unpredictable policy shifts. The principle applies broadly. Seek markets where your competitive advantages matter more than political connections, where product quality influences outcomes more than regulatory favor, where customer value drives success more than government support. These markets still exist. They require careful identification, but they offer genuine opportunity. The fourth strategic imperative: prepare for the inevitable correction. Every price manipulation regime in history has eventually failed, not because governments chose to end them, but because economic reality eventually overwhelms political will. The Soviet Union manipulated prices for 70 years. The system appeared permanent until it collapsed in months. Venezuela manipulated prices for 2 decades. The intervention seemed sustainable until it produced hyperinflation and economic devastation. The United States is not immune to these dynamics. The manipulation can continue longer than most expect, but it cannot continue indefinitely. When it ends, the adjustment will be severe. Business leaders must position for this eventuality, not by timing the collapse, which is impossible, but by building resilience that allows survival regardless of timing. This means several concrete actions. Reduce dependence on artificially cheap financing. Many businesses have structured operations around historically low interest rates maintained through government intervention. When rates normalize, these business models fail. Restructure now, while time remains. Avoid assets whose valuations depend entirely on continued intervention. Real estate and markets supported only by government programs. Stocks of companies profitable only due to subsidies. Bonds of entities viable only through bailout expectations. These assets are catastrophic risks. Build relationships and capabilities that function in disrupted environments. Supply chains that don't depend on just-in-time delivery. Customer relationships based on genuine value rather than subsidized prices. Workforce skills that remain valuable in restructured economies. A family business in the agricultural sector implemented this approach in 2024. They reduced debt aggressively, even though cheap financing was available. They diversified suppliers beyond the most efficient options, accepting higher costs for greater resilience. They invested in storage and processing capabilities that seemed inefficient in stable conditions, but would prove invaluable in disrupted ones. When agricultural subsidy programs were suddenly restructured in 2025, competitors collapsed. This business barely noticed. They had prepared for disruption, and while others had optimized for stability that was always illusory. The fifth strategic imperative: accept that political analysis is now economic analysis. This is perhaps the most difficult adjustment for traditional business leaders. They entered business to create value, not to navigate political systems. But in a manipulated economy, political decisions determine economic outcomes. Understanding regulatory priorities, policy trajectories, and political incentives is no longer optional. It is core business intelligence. This does not mean becoming political. It means becoming informed about the political factors that now drive the prices and conditions affecting business operations. A technology company CEO resisted this reality for years. He believed good products and efficient operations would ensure success. He avoided Washington, ignored regulatory developments, focused purely on business fundamentals. By 2025, he recognized his error. Competitors with inferior products but superior political intelligence were winning contracts, accessing capital, and gaining regulatory advantages. He was fighting with one hand tied behind his back by his own refusal to acknowledge how the game had changed. He hired a team specifically to track policy developments, regulatory changes, and political dynamics affecting his industry, not to seek favors, but simply to understand the environment. Within a year, his strategic decision-making improved dramatically, not because his products changed, but because he finally understood the actual rules governing his market. The final principle: maintain ethical standards regardless of systemic corruption. When markets are rigged, the temptation is to abandon principles, to seek political favors, to manipulate in return, to accept that corruption is simply how business operates now. This temptation must be resisted, not primarily for moral reasons, though those matter, but for strategic reasons. Manipulated systems eventually collapse. When they do, those who built success through political connection rather than genuine value creation lose everything. But those who maintained real capabilities, real customer relationships, real operational excellence, survive and thrive in whatever system emerges next. The business leaders who will dominate the next era are those who navigate the current corruption without becoming corrupted themselves, who understand the manipulation without depending on it, who adapt to the rigged game while building for the day when genuine markets return. That day will come, perhaps not soon, perhaps not smoothly, but inevitably. And when it does, the prepared will inherit what the manipulators destroy. The free market is not over. It is suspended. Your task is to be ready when it returns.